Everything has started in the negative, starting with the crude oil prices, where we've seen more than a percentage point of a decline coming in, and that seems to be deepening right now. If you calculate from the highs that we saw in the previous year for the Brent prices, where 86.5 was our 4-year highs, we've come more than $3 week for the crude oil prices. This is after the US says that they would be looking to give exemptions or waivers from the Iran export sanctions from 4th of November. That is where the deadline is, and especially to those countries who have been making efforts to ensure that the sanctions actually are, justified in that sense. The crude oil prices have not been the only space. We also have seen those kind of declines actually come in for the precious metal prices. The US dollar has strengthened, even as China did come out with steep cut in case of the reserve requirement for the banks. That hasn't had that desired impact for many of those commodities. So 0.25% up on your screens is how the dollar index is, and a decline is what you can see in the metal space. Silver is down by a percentage point, and that pretty much is the scenario for the other base metal prices, where we have seen cuts of anywhere between 1 to 3% on the lower side. Aluminum, of course, is a bigger casualty there. We have seen a double whammy onto that one as the supplies come back in Brazil, and you also are looking at strength in US dollar and the China slowdown concerns, all of that weighing onto that space. But let's keep it to crude oil prices, and Reza Amanat from Argus Media now joins us on the phone line to discuss more about that. Reza, hi. Crude, the kind of cuts that we have seen come in and the kind of speculative positions which had been holding long, they have been unwinding as well. Will you call it more a US impact, or is it got to do with the kind of money that suddenly moved out of the long positions?
I think when you see a decline across the commodities spectrum, as you mentioned earlier, you have to maybe look at the strength of the dollar, and maybe that has more to do with the current declines across the board on commodities than any fundamental factor. But having said that, there's probably a little bit of over-exuberance in the last 10 days in terms of how the crude market reacted to fundamental news. There's a lot of uncertainty about the U.S. policy towards Iran sanctions in terms of whether buyers will be exempted or not. I think so long as this sort of ambiguity stays in the market, you will get these volatility and people reacting to the smallest bit of fundamental news.
So what would you say? Would you say that the prices on where they stand right now, of course, we have seen a correction in the markets, but even then, the global spare capacity is low. We have seen the US rig counts continue to decline, and the uncertainty about Iran, of course, is still in the markets. Do you see this correction as a buying opportunity, or would you say that we more or less stand on more fair prices right now?
I think so long as there's uncertainty in terms of supplies, then there's always potential for crude prices to go back up. There's no clear sign that this ambiguity is going to go away anytime soon. But also, when there are these sort of unknown factors in the crude market, then you do get a hyper reaction to the smallest bits of news when people feel as though the market is going to be tight in terms of supplies. So once you do get a run-up in prices, then you inevitably get a correction as well. And this is what seems to have happened over the last few days.
Reza, what is your sense on the prices from here on? Because we saw many banks, brokerages, oil merchants come out with reports suggesting that $90, $95, $100 perhaps is a possibility. And that is what really has been, scaring Asian countries, big consumers like us. What is your own sense on where are we moving?
Well, it's difficult to say in terms of exactly where the prices are going to go. As I say, there's a lot of potentially fundamentally supportive news out there, sanctions on Iran being one of them. But you also have to balance that out with other news. For instance, the fact that there's less exports going to China from the U.S. Those exports will then have to be absorbed by other buyers. And so that's potentially volumes of crude that need to find a home there. There are more bearish reasons out there for crude to perhaps cap its gains as well. So we are at the moment. I think what's interesting is that crude prices look quite comfortable above $80 a barrel, which hasn't been the case for the past year and a half. So in a sense, we have maybe broken the ceiling there and are likely to see crude prices stay stable, but perhaps above $80 a barrel.
What also is your sense about the OPEC and the allies meeting that would be in the month of December? So it doesn't really end in November because the uncertainty on what the other oil producers would do would continue to stretch by the year end as well. When you look at the overall fundamentals, what would you want to watch out for now for the remainder of 2018?
Well, I think there's disruptions, weather-related disruptions that are still on the horizon. There's also obviously the fact that OPEC members have been obviously apart from Iran, but say the rest of the OPEC membership has been making the right sort of noises to try to calm down the prices, even with this issue of Iran sanctions. But that doesn't seem to have really worked that well. I mean, Saudi Arabia has come out a number of times saying that they've released more crude into the market and they have spare capacity to meet supplies, but it didn't really stop prices from going above $80 a barrel. So that kind of goes to show that there isn't that much confidence in the noises coming out of OPEC at the moment. So I'm not really sure how much impact they could really have as a group in the next meeting on failing, a decision to just increase supplies outright.
Point taken, Raza. We'll let you go at that. Thank you so much for joining us. So that's the view coming in from Argus Media. The crude prices do look comfortable above $80 per barrel, and we continue to hold above those levels even after we have seen statements coming from US, OPEC and Russia as well about increasing supplies. That really tells you something in sense of prices and the attitude in the international markets. But let's get in also some commodity trading ideas, and Navneet Damani of Motilal Oswal now joins us for that. Navneet, hi. What is your sense for the crude oil prices? I mean, with whatever we've been talking, even with the profit taking, yes, we are still holding above 82, 83 levels.
Yeah, well, we've seen that crude oil prices over the last couple of weeks have been getting some bearish fundamental, but not much of that has been getting priced into the commodity. From 80, 81, it's been swiftly moving towards $85 and now hovering between 83 odd levels. I think there could be a short-term play where the fundamentals could come into picture and some retracement could be seen after the huge rally that we've seen. But having said that, the targets that you mentioned earlier, 90, 95 levels, are still continues to remain open. So this correction that we are seeing is just a blip or probably a few days consolidation that we might see in the market. For the short term, we would expect that 80.50, 80 could be on cards before any meaningful buying kicks in.
Navneet, how have you seen the metal space today? Because we started okay in Shanghai, but then it just gave into profit taking there on LME as well. The Chinese the steep cut in sense of the requirement ratio from banks also is something that did not support the markets. How are you reading this behavior?
Well, metals have been actually very mixed over the last couple of weeks, where aluminium and copper has zinc. These three metals have been rallying the most, whereas other metals have been kind of left out. So this is the impact that we are seeing on all these three metals, where most of the correction is at the moment getting priced in. The RRR cut was a big surprise for the market. The expectation largely was of a 50 basis point cut, but a 100 basis point cut has now actually surprised the market, and it looks like some bit of more correction could be on store. So we would not be very confident on many metals, but having said that, selective buying like copper could be very attractive at around 350 levels on the MCX.
How are you looking at the precious metal space as well? Because this has been an area which has been quite lustreless. We have seen US dollar continue to be the currency favored in 2018, even as a safe haven, even as we have seen bank interest rate hike from there. So the money really seems to be moving in dollar and treasuries, which hasn't been so great for the precious metal prices. How do you see the year ending? For India, of course, it has been good because of the rupee depreciation. We are almost nudging 32,000 mark here. But what is the trading strategy for near term, slightly longer term as well?
See, over the last 2-3 months, we've seen that a lot of domestic as well as international news has been kind of built in, which could have actually set a positive tone for the gold prices. But that's not what the case has been. It's been hovering between $1,150, $60 to about $1,220. So until a clear, decisive breakout of this range takes place, this more or less range-bound trade is likely to continue. 1220, 1225 could be a very strong breakout level above which we can expect 1270 in the very short term, and that is our target for the next couple of months. On the domestic front also, we expect 32,200 to 32,500 to be the target by December 2018.
Point taken, Navneet. And thank you so much for coming by and giving us strategies to us on a difficult day like this, where we have seen a more sell-off than buying in all of that asset class. But with that, that's all the time that we have on this edition of Closing Bell. After the bell comes up next.